You said you were optimistic about 2019. It's going to look a lot different than the end of last year. So is that it? Have we seen the bottom? Are you willing to go there?
I'm pretty sure we've seen the bottom. I'm a little disappointed in how the market's gone up in the last few weeks. It hasn't gone up as strongly as I'd like. I've been expecting kind of the V concept I talked to you about last week and before and have written about. And fundamentally, it's been a little less steep than that. But there's so many reasons that stocks should rise this year. And I don't have the next 7.5 hours that I'd need to cover all of them. But the fact of the matter is, we could rattle through point after point after point. This should be a very happy year.
So what is the top couple of reasons why we should rally?
We had a correction. The aftermath of corrections on average in the history of the S&P 500's 34% in the next 12 months. The fact is we had valuation contraction last year, obviously. Every year when you've had valuation contraction, the next year you get valuation expansion. So unless earnings fall, you get a positive year. We've got the third year of a president's term I've talked about here before, which has been positive every year since 1939 and averages positive 17%. You can go on and on. Some people believe, which I don't really, that we've had a yield curve inversion. But if you look at yield curve inversions as formally defined in the past, you got 4 of them where there was a yield curve inversion without a subsequent recession. And the fact of the matter is they're all positive, and they're all double-digit positive, actually all over 15%. You can go on and on and on and on. The aftermath of bad years for the market is good years unless you get a global recession or you get a world war, and neither one of those are in the cards. Let me just go back to one more point real fast. Look at LEIs around the world and look at PMIs around the world, and people poke at negatives, but the fact is that's because the sentiment is looking for negatives. Overall, they're overwhelmingly positive, speaking to growth.
Does it concern you at all that the government is still shut down with seemingly no end in sight?
I love that you asked that question. Oh, by the way, look at the aftermath 12 months later of government shutdowns. It's particularly the long ones are double-digit positive. The fact is the fears in the market now, I don't want to speak to what happens in the next few days or weeks about government shutdown. I don't have a clue. But the aftermath of all of these government shutdowns, you can lay them all out, and the aftermath is positive, and the long ones super positive.
What do you think? Get out of it first to get to the aftermath.
Well, exactly. You have to get through the rest of it for now. What do you think about the global growth outlook? And if we do see a slowdown in other international markets, if that's China or Europe, do you think the U.S. economy and stock market can shrug that off?
Let me go back to that. Again, if you look at LEIs in China and LEIs in Europe, they're strong, high, and positive. They bounce around a little, and trying to be too precise about little bounces is a wrong-headed way to do it. But if you just look at the leading economic indexes, pan-European, they're strong. If you look at the PMIs in the countries where they're individually weakest, the PMIs are strong. We have a growing world with minor pockets of negativity, but most of it, 85% of it's growing, 15% of it's not. And the 85% will pull the other 15%. And if it only pulls it this much instead of that much, it's still positive. And in a world where people are looking for the negative, that's enough. That's all you need. Higher valuations with rising earnings is plenty.